Statistician of the country, Abhishek Upadhyay, the senior economist at ICICI Securities PD, and Madan, the chief economist at Bank of Baroda. Gentlemen, thank you very much for joining me on the show. Well, Dr. Sen, first thoughts, you had perhaps about 20 minutes to look at the numbers. Okay, Dr. Sen, if you can hear me. Okay, I'll just get to you in a minute. Abhishek, can you hear me?
Yes.
Okay, Abhishek, what are the first takeaways? 6.4% growth. That means a second half growth of 6.7%. You think it's a realistic estimate?
We think it's a realistic estimate. We were assuming a 6.5% growth for the full year. The reason we believe these numbers are credible is because most of this acceleration from 6% growth in first half of the year to 6.7% in the second half is coming from largely two sources. One is government spending, which grew about 2%. Government revenue spending, which grew around 2% in first half, which is seen growing around 6% in second half for a full year growth, which is lower, which is consistent with what a center has budgeted and which is broadly consistent with the state spending pattern also, which is more geared towards civic spending anyways. And the second trigger, which is also boosting the private final consumption expenditure part, which is seen growing stronger in H2, is the agriculture GVA bit, which is agriculture growth is seen at around 4.5% in second half from 2.8% in first half. So both these drivers combined should add around 70 basis points to overall growth, and that is broadly the acceleration that we are seeing from first half. So numbers look credible, and 6.7% growth in the second half of the year is a reasonably good growth, which is consistent with our trend growth. And as we head into the next fiscal year. So it's a reasonable momentum as we head into the next fiscal year. Although these are estimates still.
Yeah, 1 minute. Yeah, I agree with you. Abhishek, let me just take your first point about capital formation. The gross fixed capital formation number is showing a growth of 6.4% according to the advance estimates, right? Now, if you do the math for the first 2 quarters for which we have, that was also 6.4%. So are they underestimating? After all, we know that government hardly spent in the first half. So do you think that we could do better than these numbers?
So tailwind mainly from government spending in agriculture. The overall capex is flat, which is fair, I think. I mean, in the first quarter, growth was very strong. Second quarter, it was weak, in line with very weak manufacturing sector performance. I don't think there is anything strong to suggest manufacturing sector performance will improve drastically in the second half of the year. Also, what we need to be cognizant of is that while center has budgeted capex strongly, they may not be able to achieve these targets. So in that light, I think the numbers look reasonable. In fact, I don't rule out some downside basically to this capex growth estimate.
Yeah, I agree with you because it appears from media reports that much of this capex is simply transferring the interest-free loan to the states. And there is now talk that even the conditions will be loosened because the states are not able to meet those conditions. That doesn't look like real capex spending. It seems to look like more transfer of resources. So we probably could fall short over there. Madan, Sabnavis, your first thoughts. I thought what was exhilarating also is that personal final consumption expenditure has been estimated at 7.3%, much better than the 4%, which means, consumption appears to have picked up according to the estimates.
Okay, according to me, Latha, I think these numbers of 6.4% will see an upward revision. We should remember that in the methodology which has been placed by the NSO, it's a case of extrapolation of whatever has happened in the first half of the year, plus whatever updates are there for the months of October and November, they have been used. So we all know that in the first 2 quarters, corporate results were not really good, but I don't expect them to be substantially better, but definitely there'll be an improvement. And that is something which we will see in these numbers. So even when you're talking of something like investment, I think the slow investment in both private as well as government as far as government investment is concerned. I think these are things which have already turned around, because if you look at the investment intentions of the private sector post-elections, it's been substantially higher than what we saw last year. So therefore, I think there's reason for us to be sanguine that we could probably be around the RBI number of 6.6% by the end of the year, with a revival in both consumption and investment. The numbers here are very conservative, and probably they should be conservative, because I think the use of this number is that it will be used in the budget formulation, which always have to be conservative, so that you don't make you're closer to target rather than overestimating your revenues. I think that's why these numbers are kept conservative. So I think that these numbers are fairly okay, and we will see an upside when we have the final numbers. We should remember that 3 months of the year have not even passed by. So we're talking of things which have happened up to October, November, which are being extrapolated. So I think we should take it with a pinch of salt.
Okay. Well, I cannot recall, but I have seen some years in the past when the final numbers, which come in May, on May 31st, have not lived up to the advance estimates. So it isn't always that the extrapolation is conservative. It was conservative last year, but last year was a messy year with those subsidies playing a lot of hooky with an 8.2% coming. So I would hold my horses and let me leave it to the former chief statistician. So, Dr. Sen, is it that these numbers are usually conservative and we should expect the advanced numbers to be an improvement?
No, I think what Dr. Sabnavis said is correct. Not on the saying that it's going to be revised upwards. That's not the correction. Okay. But that there are a huge amount of extrapolation that's going on to get these numbers. Right? And these extrapolations are based on the past experience. Now, one of the things why both you and Madan are correct is because the last 4 years have been so unusual that extrapolating using past information isn't working very well.
Okay.
All right. So the net result is you can err on either side.
Okay.
So you're both correct on this.
Okay.
But
right.
my personal sense on it is that it'll probably, if it does get revised, it may get revised downwards. Because I don't think the fourth quarter is going to be all that great either.
Okay. Okay, yeah. Now that is your perception from your vantage point as you look at the economy. I take your point, sir. Let me come to the nitty-gritties. I was impressed by the personal final consumption expenditure that has been estimated at 7.3. If you remember, last year it was 4%, and we were ruining the fact that growth was entirely because of capital formation and not because of consumption. Is this something very positive, that consumption has finally arrived, Dr. Sen?
Again, Latha, we need to be very careful, right? We are talking about the 7.3% growth on the basis of past years' consumption. Okay, that's the base. What is important is to look at the momentum. That is, compared to the last quarter for which we have data, what is it that is being expected?
Okay.
And that doesn't look quite as rosy. So having a 7.3% growth in consumption on an estimated GDP growth of 6.4% sounds very good.
Okay.
But I don't think that's the reality.
Oh, right. Okay. Well, let me get to another aspect. Okay. Anyway, the consumption part, Madan, what would your take be? You think 7.3 is a reflection of reality, or is it just lower base impact? Any thoughts? I mean, FMCG guidances have not been exactly exhilarating.
Actually, we've gotten a different kind of picture if you look at the unorganized sector. Or maybe what I mean by unorganized is I'm not looking at the big companies which declare the results and have said there is an urban stress. We've actually seen in the non-formal kind of sector, like for example, even if you're looking at things like soaps, shampoos, other cosmetics which are being consumed, chocolates, biscuits, which are coming from the unbranded or the lesser known branded products. They have done actually very well, including in metro cities. That's what our survey has actually shown. So I think contrary to the kind of picture which we get when the MNCs come on your channel and they say that there is urban stress, definitely we have seen that their sales have not been growing at a desired rate. We get a contrary kind of picture. So therefore, I feel that there is definitely reason for us to be positive in terms of consumption. I think the 7.3% number you're talking of looks very much real. It could be slightly better in case the rural demand is able to support it in a more decisive manner.
Okay. Well, let me now come to the nominal GDP number. That's come in at about 323 lakh crore. And the budget had assumed 326.3 lakh crore. So, Abhishek, the government will have to arithmetically bring down its fiscal deficit by about 30,000 crore. Not a big ask, is it?
Right, Latha. So, I mean, if the fiscal deficit was to be close to the budget numbers, then it will be 5% of GDP and not 4.94%. So, very modest change. And it is quite likely that actual fiscal deficit will be lower than what was budgeted, given the trends on the revenue side, particularly, as well as the expected undershooting of the capex spend. So in that light, we think fiscal deficit will be lower. In fact, if you look at the way government has managed the borrowing, they've already slashed the T-bill borrowing, if you base it on the calendar, as well as they have done buybacks. So these two segments combined would imply government is anticipating anywhere between 1 to 1.5 lakh crores of saving. This is not just fiscal deficit. This is fiscal deficit savings plus savings on the financing bit. So I assume out of this 0.4% reduction in borrowing, which has taken place so far, roughly about half of it will be reduction in fiscal deficit. So deficit could be around 4.8%. Therefore, is what we are penciling in right.
Oh, okay. Then it's not a big ask at all. If anyway, they have slashed some expenses. Any other important takeaways from these numbers, Abhishek? Then we will move on to guessing the next year's growth. Anything that we should take note of as an outlier number?
I think, Latha, so I mean, the reason I assume these numbers are credible is because in the first half, we assumed, again, agri and government spending were the weak bit, and we assumed these two segments would be driving growth, right? We didn't have, much to contribute in terms of saying the other numbers are wrong. So, I mean, that is why we think, given these two segments are expected to drive growth in second half, that is why we believe these numbers are credible. Also, 6.7% growth broadly, given the historical data, seems reasonable as well. So that is a broad takeaway. I mean,
okay. Madan, anything I have missed? I mean, in terms of, say, my personal feeling is trade, hotels, transport and communication are usually very labor-heavy sectors, and they are expected to grow only by 5.8% versus a 6.4% earlier. That was one of the sectors that really got weakened during COVID. Is that a bother, or is there anything positive to note in any other sectors like construction, which is still going strong at 8.6 over a 9.9% last year? I mean, I'm just throwing numbers at you, but anything important that you took away?
No, I think that's a very positive sign when we're looking at construction, because this looks more at the housing sector as well as what the government is doing on roads. And therefore, I think that this is one of the engines which has been firing and done well even in the second quarter. So we had seen a lower number, but it was still very impressive over the high base effect. And that's the reason why I think we have seen the construction sector being one of the leading engines of growth, along with, say, agriculture and the government sector. And this is something which is a positive takeaway. And that's one of the reasons why I believe that finally, when you're looking at the numbers, it's going to be higher than 6.5%, maybe closer towards 6.6%. Now, in terms of the trade transport, I think it comes as a kind of a surprise, because if you look in terms of what's happening on the consumption side, just based on the GST and the e-way bills, I think this number should be showing a higher growth number. And that's probably the base effect which has kept us down. And when I'm when I'm talking in terms of growth going at over 6.5%, maybe 6.6% for this year, it is premised on the fact that consumption is something which is going to continue to grow at a steady rate. Maybe the 7.3% will move up slightly upwards towards 7.5%, 8%, which means that we will also see this trade component also do very well. Because we have seen that the services sector has done very well. There's a lot of experience expenditure which individuals are consuming, which are spending on, and all this actually gets reflected in this particular segment. So this could be a slightly understatement is what I feel for growth for this particular segment.
Okay. Any thoughts, very quick thoughts, Dr. Sen, on this 5.8%? For me, that was the unhappy number in the whole picture because it is an employment-heavy sector. 5.8% growth, trade, hotels, transport, communication, and broadcasting.
You know, it is disappointing because in a, I think, important sense, these are the sectors which are bellwethers of what is happening to consumer sentiment. And how comfortable people are feeling out of getting out of their sort of traditional consumption patterns. And this has always been a sector which has tended to lead the economy rather than follow. So I think the 5.8% number certainly is disappointing, but it's also to sort of take note of, it's important to know that this sector is relatively difficult to estimate. So a lot of hand-waving does take place when we estimate it, except for transport, which is pretty easy to calculate. So I think, but 5.8% is worrying.
Okay. All right. Those are, erudite opinions that we are getting on the number. Dr. Sen feels that we could see 6.4 also being tough to reach. Madan Sabnavis feels that perhaps the surprise will be positive. But I think the more important part is this is the first step of the budget where you get the nominal GDP set for the current year. On it, the budget will estimate the nominal GDP for the next year and then derive the tax growth and the fiscal deficit. What should those estimates be? Those questions to my guests after a very short break. Welcome back. You're watching the State of the Economy special where we are looking at the advance estimates of GDP for the current year. The estimates are a bit of a disappointment if you go by the prevailing official statistics. The MOSPI is estimating current year GDP, real GDP growth adjusted for inflation, that is, at 6.4%. The last number we have is the Reserve Bank's, which was 6.6%. So we are falling short over there. And the other number, the budget number of nominal GDP, originally estimated at 10.5%, the MOSPI says that the nominal GDP, that is not adjusted for inflation, GDP growth is 9.7%. On both counts, therefore, less than originally estimated. But where does this leave us in terms of the year that will be? I've been speaking with Dr. Pronab Sen, Abhishek Upadhyay, and Madan Sabnavis. Gentlemen, thank you very much for your patience. Dr. Sen, what is a reasonable assumption for next year? As good as this year, real GDP and nominal GDP? 9.7,
Well,
6.4 or better?
For the budget purposes, the nominal GDP is important. And I think the government can get by with actually assuming something like an 11% growth. A
Why do you say that?
A 6.5% plus a 4.5% inflation is perfectly reasonable, and it's well within their inflation targeting and seems consistent with our longer-term growth trajectory.
Okay. Well, it's just that, the WPI, which is what is part of the deflator, I think, is it 60%, sir? The WPI has been running at about 3%. And the CPI next year, according to the Reserve Bank, is going to be closer to about 4.3%, thereabouts. So can we assume 4.5% in terms of inflation? Would be a question. Abhishek, your thoughts. What should the nominal assumption be and the real?
Latha, we are assuming roughly 6.5 to 7% growth for next year as well. In fact, 6.7, 6.8% growth to be precise. The reason for that simply is one, that is what we think our trend growth is. And then additionally, what will happen as we head into the next fiscal is that we'll get some easing from RBI, some monetary policy easing from RBI, which should be a tailwind. Also, the pace of fall in fiscal deficit is going to come down. So that will incrementally be a tailwind also. So in a world where growth is roughly flat between the current year and next, given these drivers, we think overall growth should be quite resilient. And in terms of nominal growth, we think the WPI inflation, which has been quite low, which should average around 2.5%, in the current fiscal, will average slightly higher next year, even assuming relatively subdued global commodity prices. So given that, we think nominal GDP growth could be around 10.5%, which we assume will be the assumption in the budget also.
Okay, that will be comfortable, of course. So that's pretty much close to what Dr. Sen is saying, except that you're a little more confident of the real GDP growth. I wonder why you gentlemen are not worried about possible trade wars and global uncertainty. Madan, what would be your best guess of both real GDP and what the budget should assume as nominal GDP?
In terms of GDP growth for this year, I think based on this information and the upside which could be coming about by May, I think we would be looking at something like closer to 6.5%, 6.6% for 24-25.
Okay.
On top of that, I think for next year, we could be closer towards the 6.8 to 7% range, which really means that the government could probably retain the number of 10.5%. I think what Dr. Sen was saying, 10.5 to 11 looks reasonable, but to play conservative, they could go at around 10.5%. We should just remember that these base effects are something which has been plaguing most of our data. 8.2 leads to something lower. Now a lower number now is going to lead to something higher. So even in terms of WPI, if we get 2.5, 3% this year, I think it was going to provide that kind of a cushion for a higher number for next year. So therefore, I think 10.5 to 11% looks fair enough, and more likely government could play conservative and stick to 10.5% for nominal GDP growth.
Okay. All right. I'm just trying to calculate if you have a 4.4% GDP, 4.4% fiscal deficit, the GDP at 10.5% works out to about 358 trillion. And at a 4.4% GDP, is that what fiscal deficit? Is that what, Abhishek, you're saying? If it is indeed 4.4%, then the fiscal deficit should be 15.7 lakh crore. Pretty much same as what it is this year, which will be very good for bond markets, actually, because that much borrowing less. So to cut a long story short, Abhishek, positive for bond markets then next year, given that you're expecting the Reserve Bank to be generous with liquidity, cut interest rates a wee bit, as well as, probably only a 14 lakh crore borrowing?
We have to see the borrowing estimate, Latha, because in addition to fiscal deficit, there are other drivers which could have a bearing there. Issues like whether the bonds that RBI currently holds, whether they choose to swap it with the government or not, and whether government chooses to retire some bonds, GST bonds prematurely, etc. These are additional triggers which could lead to volatility in the estimate. But broadly, we do assume that gross borrowing number will be anywhere between 13.5, 14 trillion, which is what has been the case in recent years. And if that is the number we get, then the bond market should be reasonably happy with that.
Okay, fair enough. Very quick questions, if I may. Dr. Sen, do you think global can be a headwind?
It's difficult to tell, Latha. At the moment, we have conflicting trends that are going on. The US is certainly doing much better, but then as Mr. Trump takes over, things become much more complicated. And that really, at the moment, I think is the elephant in the room. Because if he, in the first couple of months of his tenure, if he tries to implement a few of the promises that he's made during the elections, then the global economy is going to be in a great deal of turmoil. America is not going to get affected that much, but the rest of us will. So for next year, I think we need to keep our fingers crossed. All the estimates that I think all of us have made, and we all pretty much agreed, it really depends upon assuming that nothing really dramatic happens to the global economy.
Okay. Yep. Exactly. Why worry? Why pay an interest on worry before it is due? We'll wait and see what President Trump does, and whether India is in the firing line at all, or whether we are actually beneficiaries of the US policies. Probably there will be cheaper commodity prices because of that, and that could also be an advantage. Let's wait and see. Thank you very much, Dr. Sen, Abhishek and Madan Sabnavis. The key takeaway is that for the current year, the expectation from Dr. Sen is that we'll probably not even get to 6.4, but it's countered by another economist, Madan Sabnavis, who probably feels that we may do even a little better than 6.4. But the important point is they are agreed on the next year. It should be between 6.5 and 6.8% growth for next year, and the government will comfortably assume a nominal GDP growth of 10.5%. So not too many problems for the budget from the estimate of nominal GDP, which is a little lower than what the budget assumed last year. Basically, positive takeaways in terms of consumption. Consumption growth estimated at 7.3, very good number. As well, GDP growth 6.4, better than the CNBC-TV18 poll of 6.3. On that note, let me wrap up this special broadcast. Thank you very much for watching. Stay tuned for news and updates lined up for you.